Welcome to the Rebel's Edge. We're going to be covering a stock that is one of those manufacturers that it looked bad in the pre-market, but has reversed all the way to a significant gain. You want to know what that is? Stay tuned. Welcome back, everybody. I am Jon Najarian. He is Marc LoPresti, that guy over there. And Jared is handling the sound effects. So if you happen to hear something like that, that is Jared's work. All of the dates, like December 20th, as well as the dancing bulls, bears, the tickers running down the right side of the page, that's all Jared. So with that said, let's dive in, Mark, to the macro minute. Macro minute today. Market fighting its way back from a negative opening, Mark. But macro, is it that there are some businesses outside of the Magnificent Seven that are just having a real hard time turning things around, and they're trading at multi-year lows in some cases?
Yeah, that is definitely true, John. But what I was looking at this morning was the print on the mortgage demand. This is something that we've been covering since the famous dovish comments from Jay Powell a week and a half ago now, and all of the real estate data that continues to come in this week. I think we've got new home starts coming out on Friday, but this mortgage demand number coming in a little bit cooler than expected. I think that this is essentially the result of two things, John. One, a little bit of a delayed reply or a delayed response from new mortgage applicants in terms of how much really good news is there that the Fed's going to cut rates next year by 75 basis points. But secondarily, we still have that glut of existing home turnover still at an all-time low. So until we get some of those new homes on the market, we talked about this, I think, yesterday or the day before, looking good for Lennar and D.R. Horton and such, you're still going to see this tepid demand even as rates improve.
Yeah. In fact, Mark, yesterday on with Charles Payne, I used one of those stocks, but it was Toll Brothers, for a stock to watch in early 2024. That's a luxury home builder, folks. We all know luxury is a different area than, for instance, Pulte or Horton or Lennar, some of the folks that Mark just spoke of. But wow, rates coming down like this is going to make a lot of people happy, Mark. And I'm seeing 30-year rates, normal, not jumbo, 30-year rates under 6.7% right now. So that's a big, big drop.
And I think that call that you shared on Charles, nice name drop there. But yes, Charles is, of course, a friend, and you appear on his show on a routine basis. Proud to cite, I'm proud on your behalf. That the luxury home builders are even perhaps better poised than the rest because, let's face it, access to credit, easier for those that are in the higher income levels, less interest rate sensitive. And again, those new home builders making up for that lack of turnover in the existing homes. Even in the luxury home side of things, if I'm at a low rate fixed, why do I want to sell that house and buy another $5 or $7 million home at an adjustable at these rates? That's probably not very appetizing.
And probably a pretty dumb financial decision, too.
Yeah, exactly.
Let's talk, Mark, about fantastic futures.
Fantastic futures.
Well, I'm going to say that those Red Sea woes, in other words, the Houthi rebels or soldiers, whatever they might be, are attacking these ships in the Red Sea. Many of those ships are basically saying, we're not going through the Suez Canal. We're not going to make our captains and our payload subject to some attack. So we're going to go around 3,200 miles away, the tip of Africa and back up, Mark. Wow. That's $17 million a day to the Middle East if they do that. And that's why crude oil prices are jumping like crazy, because that delays that crude oil getting to market, of course.
Yeah, I mean, taking that trip around the Horn is not only a delay, but it's a significant increase in shipping cost which is a significant component of what we all pay for gas at the pump, right? What it costs to get there, that so-called midstream to the downstream when we talk about the oil and gas industry. And look, we have been saying consistently on this show, expect continued volatility in crude prices, because at some point in time, John, the chickens in terms of the global unrest we're going to come home to roost. And in this instance, in the Red Sea, they have. So not totally surprised to see this move. And until things improve, I expect to see these prices remain elevated, $80 plus. And I even saw it driving past one of the gas stations this morning. Prices are on the way up.
Yeah, and they were trying to write headlines saying, oh, we're going to see the lowest prices of the year at year end. No, we're not.
No.
When those gas stations know what's coming, which is refineries charging a lot more, folks, because of these higher prices. Brent over 80, crude oil prices moving up back up to 73, 74 mark. That is not a recipe for lower gasoline prices. No. All right, well, let's talk about that, because FedEx has certainly struggled this year mightily. They are down 11% right now, but they were down as much as 14 earlier on, Mark. Basically, the company posted weaker than expected earnings. They lowered full year outlook. Neither of those are good. And FedEx is struggling mightily to basically find a way to make money when their input costs from employment as well as crude oil are going through the roof.
Yeah, another wonderful impact of higher interest rates and this monetary policy this year. But I think the FedEx story, John, is less around demand destruction and what the company's outlook is for a recession, soft landing, et cetera, for next year. I think it's more, by my reading of the numbers and the tea leaves, a little bit more about whether or not the company's cost-cutting measures that they implemented in the beginning of the year, primarily around the second quarter, were sufficient to adjust and have their margins adjust for higher interest rates. And look, a lot of companies over time, it's been the difference between a good earnings report and a bad earnings report. And that is to say, how well prepared and how well did we execute cost-cutting measures to account for these increased costs driven by higher interest rates. And I think FedEx missed the pin on this one. But I would be hesitant to look at this earnings report and say, next year we are going into a recession. Look at the anticipated decline in demand for shipping, which means we're going to buy less things. I'm not ready to take that conclusion on this earnings report.
All right. Well, let's talk about Steelcase, because just before we came on air, Mark was pointing out the dramatic turnaround, a V-shaped bottom hitting, and it's not for any reason that I could determine, really, Mark, as a viable catalyst for that turnaround. The numbers were bad. Steelcase went down 9 or 10% in the pre-market. It was down around $11.80. That was the price, $11.80. They began the year at $7, so it was still a pretty nice lower left to the upper right movement. But now, Mark, it's over 14, same day, from 11.82 to 14. That's a dramatic move to the upside. And like I say, I can't really justify it based on what the numbers were that they put out. But apparently people are bullish on desks and cabinets for offices.
Yeah, I mean, that one's a little hard to believe. And look, pointing out a new 52-week high being achieved on this remarkable reversal in this stock from the pre to where we are today, midway through the trading day. And I think there's a couple things to unpack here, John. The traders were focused in the pre on the revenue miss. That was, $770 million versus $826 year over year. But now started to look into, well, what were the operating margins? How well did they implement their cost-cutting measures? A similar theme to what we were just discussing. Did they get their backlog in orders fulfilled? And the answer on all of those fronts are positive numbers. You had 30 cents a share versus 20 year over year. That's a big delta. Of course, their gross margin improved 32% versus 28% year over year. Their order growth, I'm not sure where this is coming from because I don't know who's decorating new offices right now. 15% year over year. But folks, since I think you're hearing from these a little bit of sarcasm from John and I in terms of demand for new office furniture, take profit on this one if you got it. Don't try to hold this thing or chase this rally because I don't know that Steelcase is look forward-looking for 2024. I don't know anybody. I don't know anybody that's looking to buy mass quantity of office furniture at this point.
Yeah, well, I would be right there with you. I am surprised, but this marks a doubling of the stock price since the beginning of the year. Today's 52-week high that Mark said, 1422 or thereabouts, is double where the stock started this year. Pretty amazing. All right, ARGX, Mark. This one, they had not met their primary endpoints. We're not going to bore you with a lot of micro babble about biotechnology or therapies, folks, but we are going to say whenever you miss, then it calls into question whether you have a viable company because of the amount of money that it takes just to get through any of these phase trials. When you fail and you have to go back to the drawing board, it is expensive.
Yeah, no doubt, John. And look, the stock's actually unchanged now as I look at it. So it recovered from the sell-off that happened in the first part of the trading day. This company, apart from this drug that's seeking phase 3, so it's not a drug in the market, not good news on that phase 3. And the only reason that this thing continues is its sale of Toro. This is a one-hit wonder. This is a patent on top of the skin, actually birth control solution that sells pretty well. Obviously, there's a fair amount of competition in the space, but that, it's not enough for a pharma company, typically speaking, to be a one-hit wonder. And the one-hit wonder pharma companies tend to get bought by the big guys if the drug is sustainable and it's not going off patent at any time in the near future. So interesting sort of mixed bag, but definitely bad news for their drug and development on that phase 3.
Well, let's focus on a stock that actually had some very positive news, Mark. Toro, TTC, is the symbol for Toro. Many of you know that's a Minneapolis-based company, I believe, Mark. So if you have that picture of Pete, I know Pete told me we had to cover this from his vacation. He shot it to me because you guys all know Pete loves talking about Minneapolis. There's the picture of Pete. On vacation, grew that beard pretty fast, but he's a big fan of any Minneapolis-based companies like Best Buy, 3M, Honeywell. The list goes on. They have a lot of Fortune 500 companies there. Toro beat by 15 cents, revenue nearly $1 billion. So they beat by over 6 million on the revenue number, beat by a lot on the bottom line number, and we just had to throw that one in for Pete, Mark, because we know how much he loves Minneapolis-based companies.
Yeah, this is an interesting one that's sitting sort of right in the middle of the 52-week of $78 a share by $117 a share at 96.39. The last print that I saw across the tape on my side. I'm just curious, where are they expecting to see growth in golf course and their quote-unquote underground construction business? And I didn't have the time before we went on air to really dig into this one. Great company, an iconic American company from that part of the world that's near and dear to our hearts. So terrific to see for those shareholders, but I don't know if they're going to continue to expect to see that kind of growth in the stock. It's probably going to settle around here for a while.
Who knows, Mark? Maybe it's climate change, and maybe all that underground sprinkler systems and all the stuff that Toro does, in addition to snow blowers and leaf blowers and lawn mowers. Maybe it's part of that. Maybe many of these golf courses need a lot more irrigation or underground work, as you said. All right, let's dive into some of Pete's Red Zone Sports, Mark. I know you guys are going to like this because top 35 of the 98 top picks have already committed, even before the signing period began. Now, what we're talking about is, of course, commitments to go to college and play football in this case. And those signing dates are big deals. These high school seniors sign up, but it's not just high school seniors. Many times, Mark, high school sophomores and juniors are making a commitment that they can't really even make at that point, but they just don't want to have all the distraction. If Georgia recruits them, they might say, I'm going to Georgia. Stop bugging me. Anyway, take a look at this list, folks, because these are the teams that have signed all these major recruits, Mark. So you look at Georgia, the rich get richer truly in this. Yesterday, you and I talked about NIL, name, image, and likeness. This is the actual recruits, 5-star recruits. Georgia got 3 of them. 4-star recruits, they got 20 of those. 3-star recruits, 4 already, and so forth and so on. You guys can go parse through that list, but pretty amazing that you've got, the usual suspects: Ohio State, Alabama, Florida State, Texas, the University of Miami, Oklahoma, and so forth. I mean, the rich are still getting richer. But just like Mark and I said yesterday, and I'm going to pose the question to you, Mark, how many of these multi-star recruits will end their careers at these schools that they've committed to?
Yeah, probably not a lot, especially the early acceptance, I believe is the name of that program, because these kids, understandably so, will tend to change their mind. And as money becomes more of a factor, and as I said yesterday, I think we're only seeing the beginning of the impact of nils on turning high school football into an industry. Good Lord, that was a Freudian slip. Into an industry in the same way that college football has become an industry as well. But I'm curious. I was a little surprised to see Notre Dame all the way at the bottom of the list. Was that a surprise to you?
Not as much, at least in the way I look at it, Mark. I agree with you. They're an iconic program, a lot of Heisman trophies, a lot of national championships. They're in Chicago.
A lot of dough, too, right? A lot of cash to spend.
A lot of cash, but they're not, when you look at the SEC, where you've got Georgia, Alabama, and all those great teams down there, and you look at the TV revenue that they're pulling in versus Notre Dame has its own contract with NBC, and that was one of the biggest contracts in college sports back in the day. But now when you compare it to what these big conferences are getting, and Notre Dame famously, football-wise, don't send us hate, folks, football-wise, they're not in a conference. They're independent. Basketball, hockey, and so forth, yes, they're in conferences. But football-wise, they get this money to themselves, which at that point, when they started this program, was huge. And now there are multiple teams that aren't at their level that are getting that same kind of exposure and money, Mark. So I think that might be it. But, it doesn't, just because you get the recruits doesn't mean you win. We'll have to see how Notre Dame turns the players that they do get into great college players. And at least Notre Dame, for the most part, Mark, does matriculate. That's a big word, but it means graduate. When they graduate, most of the guys that go to school at Notre Dame to play football, a vast majority of them do matriculate, whereas most of these other schools, it's a much lower percentage.
A little higher turnover, as I think we might say if we applied Wall Street terms to it.
I like that, higher turnover. All right, let's take one quick look, Mark, at this headline. NFL players are facing more pressure now than ever before because of betting and fantasy sports. So, for instance, it used to be if you had a bad game, you might see some hate. And in the era of social media, you might see that hate online. They might say, God, Najarian, you suck. You missed that field goal or you dropped that pass or whatever. You might see that. And it would mainly be from people really, that are fans of your school or that just are haters of your school. But now with people owning fantasy teams and betting, the way betting has grown dramatically, these players are practically getting death threats, Mark. In some cases, they are getting death threats for underperforming for the fantasy team or for not winning in terms of statistics and so forth for fantasy. So it's not just did you catch the ball, did you make the field goal or whatever. It's also you came up 2 yards short. You couldn't have made 2 more yards. So I would have got 4 points in my fantasy pool. So this is a big deal. It's becoming a bigger and bigger deal. What do you think?
Well, you got to wonder. It's a very interesting story, John. You got to wonder how it relates to a very important angle that Pete and I covered on Monday, and that is quarterback injuries, right? We have had an all-time high this year in terms of starting quarterbacks in 15 weeks of play. We don't have to go over those figures again. A trend that's been on a lot of people's minds since at least 2016, 2017, and there's been question of, is it more pressure on these QBs to be more athletic and not just be focused in the traditional sort of confined roles of a quarterback? And does it have, putting more pressure psychologically? And I think it's got to. Some guys got to have a little bit more psychological pressure from all of this social media hate to take more risks and to try to perform at a higher level. You got to think it's having an impact and could be playing into this trend of more injuries. And certainly we started off the season this year with a lot of early disappointing injuries that have changed how the season's progressed in a material way. So something to watch, and another wonderful impact of social media on on our beloved sport of football.
Yeah, I do love it. Mark does too. But I don't think anybody really anticipated that social media would move in this direction as quickly as it has. But it is subject to, the availability of sports betting as well as those fantasy teams, and money is always follow the money. There's a lot of money in these fantasy leagues, Mark, so I can't be too surprised that people care deeply about how these players perform. All right. We hope you liked how we performed, folks. And I encourage you to tune in again tomorrow, 1 p.m. Eastern Time, when Marc LoPresti and I will be back with the Rebel's Edge. As always, go to marketrebellion.com/get started to learn more about educating yourself in trading stock and options. And we will see you tomorrow at 1.